Welcome back to our last session of the day. It's going to be a discussion about financial advisor fees and value, moderated by myself. I just wanted to remind you to put your questions in the chat box on the right side of your screen if you have any questions for the panelists coming up here. I'm going to introduce our panelists for this session. First, we have Max Schatzow. He's an attorney at the law firm Stark & Stark and a member of Stark & Stark's Investment Management and Securities Group. We also have Samantha Russell. She's Chief Evangelist at FMG Suite. And lastly, we have Rick Ferri. He's an author of several books on investing, an investment analyst, advisor, and CEO and founder at Ferri Investment Solutions. Thanks everyone for being here. I think this is going to be a great discussion.
Thanks for having us.
Thank you. Thanks.
So, this is an issue that's been heating up recently on Twitter and other places, and that is, advisor fees, how those fees are structured, what advisors actually do, and whether they are paid too much, too little. As you all know, the average advisor fee is about 1% on assets under management. That's kind of the industry standard that people go by. Typically, kind of goes from there as clients have more assets. But Rick, I wanted to start with you because I know you've been very opinionated about this, but you're also familiar with different fee models in this industry. You've worked as a commission-based broker, you've worked as an AUM-based advisor. But what do you think is wrong with the way advisors are compensated?
Thank you for allowing me the time today. I've been in the industry for 33 years. I started out back in the 1980s in the brokerage industry, where I started out as a commission broker. At that time in the 1990s, for 10 years, we started transitioning that to AUM fees to try to get our clients in the brokerage industry onto a fee model. And those fees were quite high. They started at 3% wrap fee. And we were able to discount that down to 2.25% without getting approval from upper management. Then I came to the epiphany that that was way too much money to be charging clients for what we were doing. And I left that industry and started my own AUM company. And I started charging what I thought was an appropriate fee, which was 0.25% per year. And that was very successful and grew that business to $1.5 billion in assets when I ended up selling it a few years ago. And now I'm doing an hourly fee model. So I'm very familiar with all the different fee models, and I'm very familiar with what advisors do. And I really look at it as two different things. Advisors advise, and they should get paid an advisor fee for advising. And they also may do portfolio management. And in that capacity, as an asset manager, they should get paid some sort of a portfolio management fee. And using AUM for a portfolio management fee is fine. Like I said, I used to do that and charge what I thought was an appropriate fee of 0.25%. It's the advisor side of it that is really out of whack with what advisors actually do. The advisor fee needs to be aligned with the amount of time the advisor spends advising rather than the amount of money that a client has under management. They're really two separate functions. And I've worked on both sides of it, and I know the issues on both sides. And there are some models like 1% AUM that might work fine for somebody who has $250,000, because $2,500 a year for portfolio management and advice might be about right. But it gets way out of line when you start looking at $1 million or $2 million to be paying a client, to be paying $10,000 a year for a portfolio management and advice, and then maybe a client with $2 million paying $18,000 a year or something along those. Those get way, way out of whack. And we're supposed to be fiduciaries in this business. And that means keeping clients' costs down, including our own fee. And that's my view on this topic.
Yeah, so that's great start for us here. Max, I'm just going to turn to you, and how would you respond to Rick's viewpoint, I guess?
Yeah, look, Diana, thanks so much for having me. And, I think Rick's point is it's well taken, right? I don't think there's anything wrong inherently with questioning the value of an advisory fee. I think it's a healthy exercise for investors. I think it's a healthy exercise for financial professionals. I don't see there's being any downside in questioning value. I think value should be the focus of the whole relationship between an advisor and their client. But value doesn't mean you have to charge, the least lucrative amount of fee that you can earn possibly in any given market, right? It doesn't have to be the model that chains you to your desk and your phone. It doesn't have to be the model that makes you live in 6-minute intervals, right? Like, I live there. I don't want anyone to have to live there. I think it's a stressful, anxious place to live. And, I think it really limits the way you can grow and operate your business. So I oppose that model. I don't think it's for everyone, and I wouldn't sell it to you if I could, right? I saw a stat a while back that lawyers who bill hourly are twice as stressed out as lawyers who don't bill hourly. And I think that's something to keep in mind as you're thinking about how to establish your advisory fee, how to create your business model. You don't necessarily need to create these added stresses in your life. The other thing I would sort of focus on is when you're thinking about value, I think there's a lot of different ways to think about it, right? You can think about it from the investor's perspective. You can also think of it sort of from the business perspective, right? On the investor side, you can think about, how knowledgeable is the client? How much hand-holding does a client need? How complicated is their financial picture, right? There's these various things that go into determining, value. And I think just time and time spent on a client matter is not the only metric that should be used in determining value. So that's sort of my rebuttal, right? I don't think there's one right size fits all approach or one incorrect model. And I think advisors just have to be cognizant of those facts.
Yeah, that's great. I know, I know lawyers also have really high levels of burnout, among other professionals. I guess my next question for you guys is what biases exist, if any, in the AUM fee model? Because that's what most advisors use. Rick, what are some of the biases in that model?
Well, advisors who want to get paid based on assets under management are focused on how much assets under management can they get out of a client. And because the more assets they get put under management, the more the advisor is going to make personally, the more revenue they're going to make. And so the focus of the advisors in the advisor's mind, and I know this again, from being on all sides of this, is when you first meet with a prospect, when you start asking questions, what really starts shooting off the neurons in your brain is when they start mentioning the amounts of money they have and where they have it. Because all you're doing is adding it up in your head. Oh, if I got that money. Oh, if I got this money. Oh, if I got that money, how much money would I make as an advisor? And advisors, whether we're doing AUM, whether they believe it or not, or whether they want to believe it or not, they're thinking along those lines. And some of the time, not all of the time, but some of the times they do things or say things or recommend things that may not be in the best interest of the client. For example, if a client has a $1 million IRA rollover from a previous 401k, and the current 401k the client has is perfectly good. It has great investments, very low cost, say Vanguard index funds, and it allows the client to do a backdoor Roth. If you take that $1 million IRA that the advisor is managing and picking up $10,000 a year from it, the right thing for the advisor to do is say to the client, if you put this IRA rollover of $1 million back over into your 401k, it opens the door for you to be able to do a backdoor Roth. And I can tell you, by the way, which funds you should use in your 401k, but I can't get paid on it because I get paid AUM and I have to have that at my custodian in order to get paid. But as a fiduciary, the right thing for me to tell you is you should roll this IRA back over to a 401k, put it in these few index funds over there, and then that gives you the opportunity to do a backdoor Roth, or maybe if you're 72 years old, you don't have to take a required minimum distribution from the 401k. There's a lot of things. It's just one example. It's the right thing to do for the client. But if you're doing AUM, you are not going to recommend that. You're not, because you're not going to want to watch $10,000 walk out the door on your own recommendation. This is often phrased as, should you pay off your house or not pay off your house? And if you have a mortgage for $500,000 on your home and you've got $500,000 with an advisor that they're managing, and you ask the advisor, should I take that $500,000 and pay off my mortgage? The advisor is going to look at that as $5,000 walking out the door. And it's going to influence their decision making. So when you are participating in the client's wealth, when things like this, the recommendations that you make affect your own income, and you could say that you're going to do the right thing. You could tell me that all day long, but I know for a fact that that's not what happens. It's not what happens. It does affect you. You do have biases as an advisor. You're measuring things based on money that comes in and money that goes out. That's how you do things in your head, whether you like it or not. That's just a reality.
That's great. Thanks. Samantha, I want to turn to you and get you in here. Some people would argue that asset-based fees would imply that you're doing investment management, that's where the advisor's value lies. But, hasn't portfolio management sort of been commoditized?
Yeah, well, thank you so much for having me today. Look, I come at this from a marketing background. And so a lot of these conversations, I'm always putting myself, because I'm not an advisor, I never have been an advisor, but I work with advisors every day on their marketing. So my, feet are firmly planted in what is the consumer thinking? And, some of the things that are important to keep in mind is that, I really don't care how people charge or how they want to do it, but just keep in mind that certain things over time, as consumers become more equipped to understand these different fee models, and there's more of a discussion about it, that whatever you're charging will be questioned more. And we see, there's a lot of young people, there's a lot of people even in their 30s, 40s, maybe even early 50s that for years could never work with an advisor because all their money was tied up in their company 401k. And to Rick's point, they couldn't get advice because somebody couldn't get paid on that. There is such a shift right now where we are seeing younger and younger people interested in investments, not even being offered 401ks at their company sometimes and needing to invest, but not having enough assets to find an advisor to work with them. And these robo platforms have really capitalized on that. I mean, we saw, I think it was reported just a couple of weeks ago, right, that Betterment announced their AUM is now at 29 billion, up 50% in the last year. They added 56,000 new accounts. Robinhood's in the news all the time. People understand that their access to advisors for a lot of years was limited. And we're seeing a whole new crop of advisors who are focused on financial planning, who are saying, come work with me. I'll charge you for the planning. It's okay if you don't have the assets. And as those clients accrue assets, guess what? That's going to be the advisor that they want to invest those assets with later, right? So again, I think it's all about looking at what does the market want? Are you building your firm to get the most, maximum value for you, the most ROI for just the next 5 or 10 years? Are you trying to build a 30-year business? So you really need to take all of those things into consideration. But an analogy, I'll just end with this quickly, that I always give people is look at the glasses industry. Do you remember for years and years, if you wanted to go get a pair of eyeglasses, your really only option is to go to your eye doctor, and it would cost you $300-$400 to get eyeglasses. And then Warby Parker came on the scene and they were like, all of these eyeglass companies are in it together and they're making it so that nobody can get this at at a great rate. We're going to offer these glasses for $70. And people were like, how is this possible? Because it just wasn't there before. These new fee models that are coming on the market are making consumers realize there are other options. And so that's the important part, is what is the consumer perception? That's what we always need to be thinking about.
Yeah, that's great. I use Warby Parker glasses, so I know exactly what you're talking about. So I just, as a quick follow-up, Samantha, has financial planning become commoditized a little bit? Because, I think that there are some offerings out there that, you could argue kind of provide that. I think Schwab has one, but wondering what your thoughts are on that.
No, I mean, I don't think it has. Again, I do think there are some segments of the population, especially really younger people, who might be getting, for instance, all their advice off TikTok, right? There's people on TikTok telling them what they should do, that they might think that it's commoditized because they can't tell the difference. If they don't have very many assets under management, they don't have complicated tax questions, they don't need very much advice. They need like an easy budget template, which they can find an online app for, plug in their numbers, how much am I spending? How much am I earning? And what's left over? So in that regard, there are a lot of online options that younger consumers might not understand the need for more complex financial planning. And I think that's okay. It's getting them excited about it and getting them in the door early. All of this just speaks to me, though, to the point of whatever it is that you offer. Obviously at 20 over 10 and FMG for years, all we do is look at advisor websites. So many people do not explain really what the value is that they provide. And the values in that relationship and going through things with you and holding your hand and being your behavior coach when the markets tank, all of those things aren't spelled out. And so if somebody just thinks, well, I could get this advice by plugging my numbers into an app or opening an account with Betterment, you could lose them, right? And so that is something definitely to think about.
Thank you so much. Rick, I wanted to jump to you, because you were talking to me about how consumers are becoming more savvy investors. And, just look at what happened with GameStop and Reddit and, that whole debacle. But how is that affecting you financial advisors and what their value is out there in the marketplace?
Okay, so your first part of the question was investors are becoming more savvy. I don't know if people who are doing GameStop and all that are savvy, but I've seen this happen before. In the 1990s, people who had no business whatsoever getting an online brokerage firm and trading, .com stocks. So, we're seeing a lot of that right now, only we're seeing it through Robinhood and a few other speculative places. But, I don't really have any problem with that. If a young person in their 20s goes out and does some stock trading, because they need to get hurt. They actually need to get hurt a few times. They need to lose money. They need to realize that it's not easy. They need to realize that I'm not Warren Buffett. And sometimes by going out there and doing that kind of trading and losing money, just like the people in the 1990s did, they're the ones who end up turning over to doing what they should be doing with their portfolio later on when they actually have a lot of money. So I'm not against a lot of this stuff that goes on if it's just young people. Now, if it's somebody who's 60 years old who's doing it, that might be a problem, especially if they don't have much money in their retirement account. But I think it's fine for young people to be doing that kind of speculative trading just so that they learn that it's not easy. As far as people getting educated, I've noticed a big thing. Remember, when I first started, there wasn't any internet. I think the internet has done a wonderful job of educating the mass market on things like fees, asset allocation, tax management. There are nonprofit organizations like the Bogleheads.org, that are just people helping people. And these are all not-for-profit ways in which people can learn, and they are learning. I think the financial literacy is getting a lot better. I talk with people every day, and they're on the internet, and they're reading, and they're picking up articles, and they're picking up books from what they learn on the internet. So the internet has really been a great equalizer, and it's allowed companies like Betterment to grow and thrive. And I think Betterment's and Wealthfront are wonderful organizations because they teach people the benefits of diversification and low fee and low advisor fees as well. And by the way, Betterment, if you want advice, you could just you could pay a la carte for financial planning through Betterment. So it's available on Betterment. And they also have a program if you want ongoing advice for a little bit higher fee, you could use Betterment for that. Just like Vanguard has their 0.3% fee where they provide some advice plus portfolio management. So this is all happening over the internet, and it's really causing people to be better educated, and it's driving the cost down considerably of asset management. Remember, 20 years ago, I was doing asset management for clients at 25 basis points. That was 20 years ago. Okay, now what's happening is that the advice portion of it is finally beginning to be driven down to where probably it should be.
That's great. Max, I wanted to shift to you, but I just wanted to read some stats from a recent JD Power survey. It found that younger investors are more open to different fee models. So 74% of younger investors would prefer to pay for full service wealth management via a one-time fee for service model. And 73% said they preferred a subscription model. Meanwhile, just 42% of older investors support the fee for service model, 34% support a subscription model. I mean, I know there's a lot of alternative fee models out there, Max, but I guess what are some of the biases in these other fee models, hourly, retainer, and what are some of the fiduciary issues that pop up with the different fee models out there in the marketplace?
It's a really good question, Diane. And it's one of those things that, anytime we have these conversations, it's easy to forget about. There's always inherent biases in every type of, inherent conflicts, inherent biases in every type of, fee arrangement, right? And so it all depends on what type of behavior we want to incentivize or will incentivize by the arrangement, right? And so hourly engagements, they tend to incentivize maybe inefficiency. They tend to incentivize additional research hours. It tends to incentivize potentially fudging time entries and over entering your time that you've actually allocated on a client matter, right? I mean, I think that's probably one of the more common complaints in the legal industry when someone complains about their bill. They say, how did that take X amount of hours? How did that take so long? And so, sometimes there's attorneys and financial advisors who might be dishonest or disingenuous. And sometimes things just take time, right? And it's one of those things that you never really know the answer to. The other thing, about retainers and fixed fees, I think those incentivize different behavior, right? It's difficult to negotiate a fee that's fair for both parties, right? You don't know how much time, how much energy, how much value your service is going to be. Advisor has now, some incentive to charge a fee that they think, is higher. They don't want to get burned, right? Client wants to charge a fee that's lower than, they think some service costs. Obviously, the two are going to meet in the middle, or they're going to agree on the advisor's fee and accept the services. And then once you're in that relationship, I think there's a lot of incentives that creep up. If the advisor feels like their time is being taken advantage of, right, then they're going to resent that client potentially. And it can breed some hostility in that sense, or even just, a willingness to, not prioritize that client. And so every relationship, has these types of conflicts. They're inherent in whatever arrangement you choose in this industry. You can't avoid them altogether. What you can do is you can be aware of them, right? As an investor, as a financial professional, as an RIA, as a broker dealer, you can just be aware of them, right? The more cognizant you are of them, the better off you are at sort of mitigating them and being able to communicate with your clients, with your customers about, how you work on these things, how you mitigate them, how you're going to treat them right. And so, I think there's just a lot of these sort of, conflicts that arise in every relationship.
Yeah, and just a quick follow-up, Max, where does disclosure come in? And, can disclosure sort of mitigate the conflicts that can arise from fees, around fees?
Yeah, absolutely. So disclosure comes up in several different places, right? I think first and foremost, it's in an advisory agreement, whether it's a financial planning agreement, an advisory agreement, an investment management agreement, whatever agreement it is that the client signs is going to it should clearly lay out the client's fee, how they're going to pay it, what it is, when they're going to pay it, and all those details, right? And so the client from day one in the relationship should consent to whatever the fee is, right? We're not hiding the ball. I think some AUM advisors will be less than transparent with their fee on an ongoing relationship, but that day one relationship is so crucial, right? They're getting the agreement and it says exactly what their fee is. The other place where you see these fees, right, is in the disclosure brochure that investment advisors are required to have. And I think it's it's very well. Some are better than others, I'll admit, but in those agreement, in these disclosure documents, it very clearly lays out what a client's going to pay, what their expenses might be, who's responsible for trading costs, who's responsible for fees of other managers, fund managers, you name it, right? That document should spell out exactly the fees and expenses an investor will pay. And so I think disclosure does mitigate these things quite a bit. I think a lot of people are defend the unsophisticated investor and act like investors are so unsophisticated and say they don't understand these things, but they definitely get these disclosures and they understand them when they enter an arrangement, right? I find it hard to believe that someone's going to walk in, ask for financial advice, have no idea what they're paying, and just trust, their advisor, for 10, 20, 30 years. I mean, I just don't see that happening very often. Maybe I'm mistaken, but, I just don't think that's a real thing.
Yeah. Well, Rick, I wanted to turn to you for a minute, and, can you just sort of walk us through how you currently charge your clients?
Sure. Well, it's an odd thing. When I sold my AUM business a few years ago, I had a non-compete. And then when that was over, I decided I was not going to retire. I was bored and I wanted to continue to help people. But I realized there was an awful lot of people that were not looking for ongoing money management services. So many people who hang a shingle out there and call themselves financial planners. And it's true, they have a certificate hanging on the wall that says financial planner, but they're not doing financial planning as an occupation. They're doing money management. So when people were looking for financial planner or looking for somebody to do some investment planning, just to give them some financial advice, they'd contact these financial planners, and these financial planners would pitch money management services, which is not what they wanted. And it was very, very difficult for these people to find somebody or find advisors who would just be willing to work with them one-on-one and charge them a reasonable fee for the time the advisor spent with them. So I started my company. It was just me. I just brought on a colleague just last week, so number 2, if you will. But all we do is work with a client for a half a day. It's we collect information from them. We analyze what they've got. We spend 2 hours on the phone with them in a very in-depth, concentrated discussion about their financial situation and their investments. And we talk about insurances and their estate plan, and we do everything. I mean, these financial plans that people are paying $3,500 a year for, quite frankly, you can get it all done in a couple of hours if you're good at it. And then we write up a letter and send it to them, and we charge them $925. And that's it. I mean, that's what we do. And we've got literally hundreds and hundreds of people who want this. And we've got waiting lists of people who want it. What we don't have is time. We just don't have the amount of time to get to everybody. And if somebody comes back after a year or so because they want a checkup, we charge $450 an hour for that. And we've got a lot of people after a year or two that want to come back just for a checkup. So it's not a question of demand. Demand is huge out there for people who just want to talk to somebody and just want to pay them a reasonable fee for a couple of hours of their time. And so this is what we've created, and it's just an incredibly huge demand out there. So this is what we do for a living now.
Thank you so much. Samantha, I know that you work with a lot of advisors and you kind of can, have heard about a lot of alternative fee models. Are advisors actually using some of these alternative fee models? How popular are they?
Yes, I mean, especially in the independent RIA space, there is really, we're seeing more and more different fee models crop up. The most popular really being, the subscription-based model to sort of lead people to eventually become an AUM client. So I can give you an example. I actually just did an interview for a show I was hosting with an advisor from RLS Wealth Management. A lot of people might know Justin Castelli. He's the founder, and his partner, Thomas Kopelman, walked me through kind of how they charge. And it's really interesting. So they basically, if anybody has less than 350K in AUM, they have an initial upfront planning fee of $750, and then a monthly fee of $150 to $300, depending on kind of complexity that they get charged. And that's just for financial planning. If they also want help with their investments, they have a 0.35% AUM fee. Now, once somebody gets to that $350,000 mark, they kind of graduate up to this next level where from 350,000 to 1 million, they're getting, they're charged 1% AUM. And then the fee goes down to like 0.75%, 0.5%. So initially when they first sort of graduate into the program, they're actually paying less for that first year. I've heard more and more people doing things like that. So they start kind of on a subscription model. They might continue to offer a subscription model for people who that's, all they need and they don't want the investment management side. But, if you just think of our day-to-day lives and that JD Power Associates survey that you mentioned, we're just becoming conditioned to putting things on subscription, right? Like the TV that we watch, maybe I have little ones at home. If you have diapers being sent to your house, you get on a subscription. Your vitamins, your supplements, everything can be offered at a subscription model. And I think those numbers you presented are really telling in that right now, people are really split. People who've paid the AUM fee for a long time, it can be a hard pill for them to swallow to all of a sudden have to see and feel that fee from a psychological standpoint if they've never really seen it before because it just got taken off the top of the investments. And so I think offering both is also a great option from a marketing standpoint, kind of letting people choose, what's going to be best for them. I've also started to see really interesting other fee models being discussed. So I hosted a webinar recently, and a fee model that a bunch of people were talking about was a percentage of income. So charging a percentage of income to clients. Again, not an advisor myself, so I have no experience with that. But again, I think there's just a lot of different fee models that are becoming more and more popular and prominent. Flat fees, you just pay one fee per year. And I think it just represents that there is, to Rick's point earlier, a lot of people getting educated online about the fact that this kind of historic way of doing it isn't the only way, and it might not be the best way for them.
Thank you so much. And Samantha, another question for you. I was looking at a blog post on 20 over 10's website by Blair Kelly, who said that it's critically important to be upfront about what you're charging, especially in a digital first world. So should advisors list their fees on their websites, and, how should they talk about fees in marketing materials and websites?
So I don't know if Max is going to have a different opinion from a legal standpoint, but from a marketing standpoint, think about if you ever went to a really nice restaurant. There's not many restaurants that do this anymore, but they give you a menu and it doesn't have a price on it. And you're immediately like, this place is really pricey, right? Like if we don't see a price listed, we do not think it's cheaper. We think it's more expensive. And so from a marketing standpoint, when somebody lands on your website and they have no idea what you charge, and maybe they've gotten the names of 3 different people potentially to work with, and they're looking at all their websites, they might be way more inclined to book a meeting with Russell Investments over here than your firm, because it's really explicit, the value they provide, what you're going to charge, how it's all going to work. They don't need to call you and feel like they're bracing themselves for a sales pitch where you're going to justify what you're charging. And if it's sort of like, if you've ever shown up on a car lot and the cars that have the prices right on the window versus those that don't, right? Like we want to know, so we have a baseline what something costs, because we feel like somebody's not going to take advantage of us and feel like, oh, you have this much money, I'm actually going to charge you that. And I know you can find out this information in Form ADVs and all that good stuff, but again, it's just from a marketing perspective, so crucial to be upfront about it. It really impacts the way the consumer views you, and starting that relationship off in a fully transparent way.
Rick or Max, do you guys want to respond to that? Anything in terms of Rick, how should you go about putting it on your website?
Sure. I mean, the fee has to be absolutely upfront. And not only should the fee be upfront, but if you're charging AUM, you need to break it down by how many dollars it's going to cost you. So if you have $1 million portfolio and it's 1%, you have to put on there, you should put on there as a fiduciary, you should put on there, it's going to cost you $10,000 a year for me, and this is what you're going to get. And if it's $2 million, it's going to cost you $19,000 or $18,000 a year, and this is what you're going to get. It doesn't happen that way. I mean, people who are charging 1% will not put on there, it's going to cost you $10,000. I don't want you to know the dollar amount. I mean, 1% doesn't sound like very much, but if you've got $1 million and it's $10,000, it's a lot of money. So, mutual funds, you have to do this. With the mutual fund prospectus, if you open it up, it says if you have a certain dollar amount in this fund, I think it's $100,000, this is what the fees are going to be in dollar amount. And it tells you in dollar amount how much this mutual fund is charging you. People can understand that. That needs to transcend into the advisor community. The rules for mutual funds, where it shows you the dollar amount that you're paying, has to start showing up on advisor websites, not just percentage. It's got to be broken down into dollars. It's the only way people are really going to understand how much they're paying.
That's great. Max, anything from a legal standpoint?
Not really. I mean, I think the client ultimately is on notice about their fee. It's going to be in their advisory agreement. It's going to be in their Form ADV. I think they will typically see the deduction of their fee in their custodial statement quarterly, for most AUM-based advisors. And so, yes, I mean, I think, personally, I think advisors should be straightforward with it. They should be transparent. They should discuss it every opportunity, every client meeting. I think it's a better business practice. But that said, I think clients have to be, almost, putting their head in the sand to say they don't know their fee, because I think it's just present in so many different places.
We got a couple of questions here from the audience. One is, how do you answer the charge that the lowest possible fee is always the right fee? And if financial planning gets automated for 15 basis points, how much more can or should an advisor charge? I don't know who wants to take that one.
Well, I don't think AUM should be used for financial planning. Again, you need to separate these two services. There's portfolio management. What are you charging as a portfolio manager to manage the portfolio? That can be some sort of an AUM charge. And then there's the advice side, whether you call it financial planning or investment advice or financial advice or whatever you want to call it. The advice side is a different fee. There should actually be two line items on a statement. To merge them together and to do a wrap fee of some sort ends up costing a lot of clients a whole lot more money than it would if it was separated and they could see, this is what I'm paying for portfolio management and this is what I'm paying for advice. So I don't really agree with doing advice via AUM. It's really not even related. I mean, you could have one client who has $1 million, is paying $10,000 a year and has one IRA rollover, and that's all they have. And they don't need any advice because they're 50 years old. They're not going to take the money until they're 72. They don't need any advice. They just need portfolio management. And then you have somebody who's got $500,000, who's got 10 different accounts. He's got kids accounts. He's got different rollovers, Roth accounts, this, that, and the other. And they are constantly calling and they're only paying $5,000. So this idea that somehow, some way, the advice fee should be based on the value of your portfolio, is this a complete disconnect? The portfolio management fee can be based on the value of the portfolio, but not the advice fee.
I would just add from a marketing standpoint, since the question is, is the lowest possible fee always the right fee? That think about your own, how you discern different products, services when you're a shopper. A lot of times if something is the cheapest, we're like, oh, that can't be the best value. So we go up to the next level, like the middle level too, right? So I don't think it's always necessarily the best marketing strategy to be the lowest either. So, it's finding, again, that sweet spot where you're providing value, you're communicating that value and people can understand it, but it doesn't look like you're trying to be like the discount service.
That's great. And Samantha, this might be another question for you. What percent of clients would still be happy paying the traditional 1% AUM if it was directly debited from their bank account rather than directly from their investment account?
It's a great question. I mean, I don't have a crystal ball to answer what percentage, but certainly all of these things, there's so much psychology, behavioral psychology in pricing. I mean, that's why for years and years, everything was $9.99, right? We don't want to round up to the next number. And it works. There's a reason people have continued to use it, is that it works. And to Rick's point before, there's a reason on so many websites you see 1% and not what that 1% represents, because we can swallow that pill a lot easier. I definitely think if that amount was being directly debited from people's accounts, it would be a lot more difficult, and not early on when they don't have a high percentage of assets, but as things get more complex. And that's, again, another thing, what we're seeing, right, is like, I can't tell you how many advisors have come and said to me, I want to start a firm where I charge a flat fee for advice for planning of X amount per year. And, 6 months later, they tell me that they're completely booked with clients because there's been all of these clients who've been paying this really high fee that are now knocking on the door wanting to work with them because they see the huge difference. So It's a great question.
That's true. That's very true. I mean, it's an educated public out there. They're becoming more educated. And there's millions of people out there who have enough money to be financial advisor clients, millions. And as these people become more educated, it's good that there are choices on how they should pay their fees. But I know that as they become more educated, that it gravitates down to these subscription fees and flat fees and hourly fees is where those more educated clients go. I mean, when I was a broker, you wanted naive clients. You didn't want them to know, really, be able to add 2 and 2 together and figure out what they were paying. That was really the marketing plan in many ways. And it was a shame, but that's really true. They were going after the lowest common denominator in many ways. Don't ask what the fee is. But, if you're getting a more sophisticated client and then people are becoming more and more sophisticated, I think that's really what's driving a lot of this. People are saying that you're trying to undercut everybody with your fee, and that's not it. It's not it at all. It's what is fair. What's fair to the client based on the amount of work the advisor is doing, based on the amount of time the advisor is putting in. We have productivity everywhere. Well, we have productivity in the advisor industry also. Why has that not been passed on to the clients?
Yeah, and I know something that you said to me, Rick, was the question is not how much an advisor should charge, it's how much should the clients pay. That's really the question we should be asking. Just a couple more minutes here, Max. I just wanted to ask you one last question. We've got a lot of current regulations affecting wealth management industry and advisors. We've got the SEC's regulation best interest, state fiduciary standards coming out, other things. Has any of that helped eliminate some of the fee-related conflicts out there?
Hold on one second. I think so in some respects, right? I think the SEC has been focusing a lot on fees, but not in the sense that we've been discussing today, right? They've been spending a lot of time on hidden fees, on hidden revenues, on third-party payments, on 12B1 fees, right? Like, they want to bring the fee discussion to the front, but they want to let advisors still have a lot of flexibility in creating fee arrangements that are reasonable and that they can market to clients, but they don't want, or they want to help avoid, situations where advisors are receiving these third-party payments without full disclosure and where they're incentivized to select these investments that create additional revenue streams for advisors, right? And so there's been a lot of enforcement in this area. There's been a lot of guidance in this area, but not necessarily in the sense we've been discussing today, Diana.
Okay, that's really helpful. Well, we're just about out of time here, but this has just been a great discussion for advisors on fees. Max Chatso, thank you so much. Samantha Russell and Rick Ferry, thank you all for being here today. It's been great.
Thanks so much,
Thank you
everyone.
so much for having us.
Thank you.